have you. Your adjusted EBITDA, 77 million, you had 16% margins, 10 full points above a year ago. And I'm just curious what you did and what you're continuing to do to see that kind of margin improvement.
Well, first, David, thank you for having me. The biggest thing is that when we started to architect a business 5 years ago, over 5 years ago in 2018 when I joined, we really focused on making sure we had the right unit economics by product. We have forward lending products, we have checking and savings, we have invest product, a credit card product. And each one of those we've sort of architected so they'll have very high variable profit. We're just getting to the point now where our financial services segment is starting to be profitable. So the lending business on a contribution profit basis has been very profitable. The technology business also pretty profitable, but we've made a big investment in the last 5 years in building out the number of checking savings accounts and acquiring them, as well as credit card and invest. And we're now to the point where we're covering all of that acquisition cost. We only lost about $4 million of contribution losses in that segment, which improved to $20 million versus Q1. And in Q4, it was negative $44 million. So what we're starting to see is the scale of that variable profit exceed the acquisition cost, which is now dropping to the bottom line. So great leverage in the business. Our incremental margins were over 40% on an EBITDA basis and over 30% on a GAAP net income basis.
Right. Well, you mentioned, okay, that operating leverage and certainly the promise of it seems to be helping shareholders feel very confident about buying the stock. Something else? I mean, you added a lot of deposits. Now, you're paying a good amount for them, over 4.2, 4.3%, but 2.7 billion sequentially. How important is that for you in terms of fueling, your ability on the other side of the balance sheet?
It's a critical point in driving both growth and profitability. So those deposits are actually a lower cost of funding for us than using warehouse lines. And we've had the bank for about a year and a half. We've added more than $2 billion of deposits sequentially each quarter, 2.7, as you mentioned, this quarter. The interest we're providing is 4.4% APY on savings if you do direct deposit. But that's actually a lower cost than what we'd be paying the big banks and warehouse lines. So it's a lower cost of funding and a more stable type of funding. 90% of our nearly 13 billion of deposits is from direct deposit customers. We want to have that primary relationship. So we benefit in two ways. One, we have the spending that they do in that checking savings account, but their deposits help fuel the growth of our lending business. And we're one of the few banks that not only provide a high APY in deposits, but we then use those deposits to drive even better returns through our loans, which have high yield, much higher than a 4.4%.
Anthony, we're showing the stock chart, and the stock has had a monster run this year, up 150% almost. Even just since mid-May, the stock is up about 75%, and a lot of that is on the move by Congress to say, folks with student loans, you got to start paying in the fall, and then also the Supreme Court knocking down President Biden's debt forgiveness plan. Some analysts on the street, though, are worried about that notion that there is a big opportunity around student loan refinancing, that is perhaps smaller than what investors think there should be. And so I'm wondering if you could walk us through what you're seeing so far and if you can address that concern.
Yeah, the interesting thing that I'd point out in this quarter is that we had our 9th quarter of record revenue. And that was driven by record revenue in our technology platform revenue, i.e. not lending, and our financial services business, which also had a record quarter. So it was the first time in our history that in our 9th quarter, that record was driven by these two non-lending businesses doing so well. Our lending business has continued to do well also, but the diversification is what's being recognized. As it relates to student loans, there's 40 million Americans that still have federal student loans that they haven't refinanced. SOFI, in our history, has not financed more than 1 million people on their federal student loans. So there's still 39 million people out there for us to help lower their cost of paying back their student loans. But that's on the come. That wasn't in this quarter. This quarter, our student loan business was still relatively depressed. We don't expect to see a meaningful pickup until the end of the year and going into 2024. But the larger thing I'd focus everyone on is that there's 40 million people that still have expensive federal student loans, and we can help them lower their cost on an interest rate basis or on a monthly basis by extending the term.
What are your expectations then in terms of that business? I mean, I'm just curious how many people are actually going to go about repaying those loans after not paying them for so long, or whether they're just going to sort of ignore them.
Yeah, no, it's a very good point, David. Our consumer or member happens to be high end. So we only underwrite prime credit. Our average FICO score for student loan refinancing is over 750. and average household income is over $125,000. So these are people that are capable of repaying their loans and will be very wise in thinking through, can they lower the cost of that loan now they have to start repaying it? And we'll provide attractive rates for those that have high rates, but we'll also extend terms for those people that just want to lower the monthly payment. One of the things that's not that well understood is that when you refinance your student loan with us, you can continue to refinance it over and over as rates go down. There's no closing costs, there's no origination fees, there's no frictional cost. And if you want to still pay what you would have otherwise paid before extending the term, you can, because there's no prepayment penalty.
You mentioned, of course, your average borrower, so to speak. I think weighted average income, I see 164,000, high FICO score. Overall, though, Anthony, what are your expectations and what are you seeing amongst those who borrow from you in terms of their willingness, not their ability to repay, but also their ability to spend? I'm just curious to get a sort of a broader sense from you in terms of your thoughts about the economy as we head towards the second half and end of the year.
Yeah, so I think we'll be an outlier to the average consumer. So what we're seeing in our personal loan business is our net charge-off rate, that percentage, actually went down sequentially. We do anticipate it will normalize back to 2019 levels, but we actually haven't seen it yet. As I mentioned, it was down sequentially. In terms of spending, our spending per account, if you annualize Q2 spending, is almost 2x more than what people spent in 2022. But again, we have an outlier customer. It's higher end. We're stealing market share from traditional banks. So it's really not a cyclical read. It's more of a secular read. So I don't want people to walk away thinking that our results are indicative of the broader economy. In terms of our outlook, as we go into 2024, we've shared guidance for 23. That guidance assumes that we do have a modest recession and unemployment does go above 5%.
Okay. That's a good place to sort of end it as well. But obviously, you're being rewarded today, Anthony, for a very strong quarter. Appreciate your taking some time with us. Thank you.
Thank you for having me.